Hey everyone, welcome back to the Stock Pro. We've got a packed global markets update for you today. US consumer confidence just cratered by the most since August 2021. Stocks are stumbling and tariff threats are shaking things up. Are we staring down a correction or is this just noise in a bigger bull market? We're diving deep into the data, markets, economics, and what this all means for your money. This one's a biggie, so grab a coffee, hit that subscribe button if you're new here, and let's unpack what's happening in the financial world. Let's start with the markets. It's been a roller coaster. Most US stock indices slid for the second straight week. The S&P 500 dropped 1% to $5,955, shedding 58 points, while the Nasdaq got clobbered, falling 3.5% to 18,847, a 676-point plunge. That's its worst weekly tumble since early September, driven by a tech sell-off. Growth stocks, especially the Magnificent Seven, think Apple, Tesla, Nvidia, took a beating. Nvidia's 8.5% drop on Thursday after its earnings report was a big headline. More on that later. But here's the twist. The Dow Jones Industrial Average defied gravity, climbing 0.95% to 43,841, adding 412 points. That's a bright spot in a gloomy week, pushing its year-to-date gain to 3%. Compare that to the S&P's modest 1.2% and the Nasdaq's 2.4% loss so far in 2025. It's clear the Dow's old-school industrials are stealing the show. What's behind the slump? 4 words: policy risks and growth fears. President Trump's doubling down on tariffs, new levies on Canada, Mexico, and China by March 4th has investors jittery. And in a cooling AI hype train, with regulatory clouds looming over tech, and you've got a recipe for unease. Small caps like the Russell 2000 fell 1.5% to 2,163, and mid caps barely budged. Volatility is back, folks. This isn't a smooth ride of late 2024. Now let's zoom into the economy. It's a mixed bag. Friday's core PCE price index, the Fed's go-to inflation measure, rose 0.3% in January, landing at 2.6% year over year. That's down from December's 2.9%, but still above the Fed's 2% sweet spot. Digging deeper, personal income surged 0.9%. Great news, but spending shrank. That's a neon sign consumers are getting cautious, maybe stashing cash as prices stay sticky. Tuesday's bombshell was the Conference Board's Consumer Confidence Index. It tanked 7 points to 98.3, the sharpest drop since August 2021. The expectation sub-index, which looks at short-term vibes on jobs and income, fell below 80 for the first time since June 2024. Historically, sub-80 readings can hint at recession risks. Not a guarantee, but a yellow flag. Worse, 12-month inflation expectations jumped from 5.2% to 6%. People are feeling the squeeze and it's amplifying broader growth worries after weeks of shaky data. On the flip side, GDP held firm. Q4 2024 growth was 2.3%, powered by a robust 4.2% consumer spending spike, unchanged from earlier estimates. Full-year GDP hit 2.8%, a solid showing, with the labor markets flashing amber lights. Jobless claims spiked 22,000 to 242,000, the highest since October. The 4-week average rose to 224,000, though continuing claims dipped slightly. Treasuries loved the weak data, rallying as yields dropped. Intermediate maturities led the charge. Municipal bonds gained too, though they trailed treasuries. Markets are sniffing out uncertainty and safe havens are back in vogue. So what's spooking the markets? Let's break it down. First, growth concerns are piling up. After a 2.8% GDP win in 2024, recent data's been a letdown. January retail sales flopped, the S&P PMI slipped into contraction first time in 2 years, and that 10-year 3-month yield curve inverting again is raising eyebrows. It's not panic mode. Some blame snowstorms for soft numbers, but momentum's fading fast. Next, policy uncertainties a buzzkill. Trump's tariff drumbeat, Canada and Mexico on March 4th, a 10% China tax, EU threats, and reciprocal tariffs by April 2nd isn't just talk anymore. Businesses might delay hiring or expansions, and consumers could cut back if prices spike. Unlike Trump's first term, where tax cuts softened tariff blows, this time the stick is out before the carrot, and that's got Wall Street nervous. Then there's big tech stumble. The Magnificent Seven drove over 50% of S&P's gains the past 2 years, but 2025's a different story. Nvidia's earnings last week, sales up 78%, beating estimates, but the smallest beat in 8 quarters, plus a profitability warning tied to its new chip rollout. The stock's 8.5% dive shows how high the bar is. 6 of the 7 are now lagging behind the S&P 500, flipping from leaders to laggards. Sentiment's tanking too. Consumer confidence is at a 3-month low, and the economic surprise index flipped negative, first time since May 2024. Investors are sour, but here's a twist. Sour moods don't always mean doom. In 2023, confidence was worse, yet spending grew 3%. People grumble, but wallets stay open. Well, sometimes. Alright, where do we go from here? The first half of 2025 could be choppy. Think soft growth and jumpy markets. But don't write off a bull yet. GDP forecasts still peg 2.3% growth. Not stellar, but above the 2% long-term average. Consumer spending cooling, not crashing, and businesses might perk up as banks ease lending and CEO confidence holds. Historically, Q1's often sluggish. 30 years of data backs that up. The labor market's a rock. Unemployment's likely steady at 4% in this week's job report, with payrolls averaging 230,000 monthly. Wages beating inflation for 21 months straight keeps income solid. AI still a juggernaut. Nvidia's extraordinary demand comment proves it. China's DeepSeek spooked some, but big players aren't slashing budgets. Tech's dip is more about lofty valuations than fading profits. Speaking of profits, Q4 earnings soared 18%, best in 3 years, and 2025 estimates promise double-digit growth. That's a lifeline for stocks. The Fed's helping too. Core PCE at 2.6% isn't perfect, but it's trending down. And falling 10-year yields, 4.25% from 4.8%, hint at more rate cuts. Sentiment's grim. 61% of investors are bearish, the most since September 2022. But that's often a buy signal. Past pessimism like this led to strong 3-month gains. A correction's on the table. We haven't had one since October 2023, and history says we're due. But 3 months of sideways S&P action might be the correction already. Diversification's shining. Value stocks, internationals, and bonds are stepping up as tech fades. The bull market's alive, just expect a wilder ride. That's your deep dive for March 1st. Markets are wobbly, but the economy's got staying power. Are you buying the dip, rebalancing, or holding steady? Let me know in the comments, I read them all. If this helped, smash that like button and subscribe. We've got the ISM PMI and jobs data coming this week, so don't miss next video. Make sure to be fully caught up and watch last week's analysis in the video on screen right now. Thanks for watching, and as always, happy investing.